In finance, an exchange rate is the rate at which one currency will be exchanged for another currency. Currencies are most commonly national currencies, but may be subnational as in the case of Hong Kong, or supranational as in the case of the euro. The exchange rate is also regarded as the value of one country's currency in relation to another currency. There is no agreement in the economic literature on the optimal national exchange rate policy, unlike on the subject of trade, where free trade is considered optimal. Rather, national exchange rate regimes reflect political considerations. In floating exchange rate regimes, exchange rates are determined in the foreign exchange market, which is open to a wide range of different types of buyers and sellers, and where currency trading is continuous, 24 hours a day, except weekends. Trading from 2015 GMT on Sunday until 22:00 GMT Friday. The spot exchange rate is the current exchange rate, while the forward exchange rate is an exchange rate that is quoted and traded today, but for delivery and payment on a specific future date. In the retail currency exchange market, different buying and selling rates will be quoted by money dealers. Most trades are to or from the local currency. The buying rate is the rate at which money dealers will buy foreign currency, and the selling rate is the rate at which they will sell that currency. The quoted rates will incorporate an allowance for a dealer's margin or profit in trading, or else the margin may be recovered in the form of a commission or in some other way. Different rates may also be quoted for cash, a documentary transaction, or for electronic transfers. The higher rate on documentary transactions has been justified as compensating for the additional time and cost of clearing the document. On the other hand, cash is available for resale immediately, but incurs security, storage, and transportation costs and the cost of tying up capital in a stock of banknotes, bills. Currency for international travel and cross-border payments is predominantly purchased from banks, foreign exchange brokerages, and various forms of bureaus. Market convention from the early 1980s to 2006 was that most currency pairs were quoted to 4 decimal places for spot transactions and up to 6 decimal places for forward outrights or swaps. The fourth decimal place is usually referred to as a pip. An exception to this was exchange rates with a value of less than 1.0, which were usually quoted to 5 or 6 decimal places. Although there is no fixed rule, exchange rates numerically greater than around 20 were usually quoted to 3 decimal places, and exchange rates greater than 80 were quoted to 2 decimal places. Currencies over 5,000 were usually quoted with no decimal places, for example, the former Turkish lira. From the end of World War II until 1967, Western European countries all maintained fixed exchange rates with the US dollar based on the Bretton Woods system. But that system had to be abandoned in favor of floating market-based regimes due to market pressures and speculation, according to President Richard M. Nixon in a speech on August 15, 1971, in what is known as the Nixon shock. Still, some governments strive to keep their currency within a narrow range. As a result, currencies become overvalued or undervalued, leading to excessive trade deficits or surpluses. Research on target zones has mainly concentrated on the benefit of stability of exchange rates for industrial countries, but some studies have argued that volatile bilateral exchange rates between industrial countries are in part responsible for financial crisis in emerging markets. According to this view, the ability of emerging market economies to compete is weakened because many of the currencies are tied to the US dollar in various fashions, either implicitly or explicitly. In general, the higher a country's interest rates, the greater will be the demand for that currency. It has been argued that such speculation can undermine real economic growth, in particular since large currency speculators may deliberately create downward pressure on a currency by shorting in order to force that central bank to buy their own currency to keep it stable. When that happens, the speculator can buy the currency back after it depreciates, close out their position, and thereby make a profit. For carrier companies shipping goods from one nation to another, exchange rates can often impact them severely. Therefore, most carriers have a KAF charge to account for these fluctuations. In many countries, there is a distinction between the official exchange rate for permitted transactions within the country and a parallel exchange rate, or black market, gray, unregulated, unofficial, exchange rate that responds to excess demand for foreign currency at the official exchange rate. The degree by which the parallel exchange rate exceeds the official exchange rate is known as the parallel premium. Unofficial transactions of this nature may be illegal. Uncovered interest rate parity, UIRP, states that an appreciation or depreciation of one currency against another currency might be neutralized by a change in the interest rate differential. If U.S. interest rates increase while Japanese interest rates remain unchanged, then the U.S. dollar should depreciate against the Japanese yen by an amount that prevents arbitrage. In reality, the opposite appreciation quite frequently happens in the short term, as explained below. The future exchange rate is reflected into the forward exchange rate stated today. In our example, the forward exchange rate of the dollar is said to be at a discount because it buys fewer Japanese yen in the forward rate than it does in the spot rate. Contrary to the theory, currencies with high interest rates characteristically appreciated rather than depreciated on the reward of the containment of inflation and a higher yielding currency. The balance of payments model holds that foreign exchange rates are at an equilibrium level if they produce a stable current account. Balance of payments, current account balance. A nation with a trade deficit will experience a reduction in its foreign exchange reserves, which ultimately depreciates the value of its currency. A cheaper, undervalued currency renders the nation's goods exports more affordable in the global market while making imports more expensive. After an intermediate period, imports will be forced down and exports to rise, thus stabilizing the trade balance and bring the currency towards equilibrium. Like purchasing power parity, the balance of payments model focuses largely on tradable goods and services, ignoring the increasing role of global capital flows. In other words, money is not only chasing goods and services, but to a larger extent, financial assets such as stocks and bonds. Their flows go into the capital account item of the balance of payments, thus balancing the deficit in the current account. The increase in capital flows has given rise to the asset market model effectively. The increasing volume of trading of financial assets, stocks, and bonds has required a rethink of its impact on exchange rates. Economic variables such as economic growth, inflation, and productivity are no longer the only drivers of currency movements. The proportion of foreign exchange transactions stemming from cross-border trading of financial assets has dwarfed the extent of currency transactions generated from trading in goods and services. The asset market approach views currencies as asset prices traded in an efficient financial market. Consequently, currencies are increasingly demonstrating a strong correlation with other markets, particularly equities. Like the stock exchange, money can be made or lost on trading by investors and speculators in the foreign exchange market. Currencies can be traded at spot and foreign exchange options markets. The spot market represents current exchange rates, whereas options are derivatives of exchange rates. A country may gain an advantage in international trade if it controls the market for its currency to keep its value low, typically by the national central bank engaging in open market operations in the foreign exchange market, or through preventing the exchange of foreign currency for domestic notes. The People's Republic of China has been periodically accused of exchange rate manipulation, notably by Donald Trump during his successful campaign for the U.S. presidency. Other nations, including Iceland, Japan, Brazil, and so on, have had a policy of maintaining a low value of their currencies in the hope of reducing the cost of exports and thus bolstering their economies. A lower exchange rate lowers the price of a country's goods for consumers in other countries, but raises the price of imported goods and services for consumers in the low-value currency country. In general, exporters of goods and services will prefer a lower value for their currencies, while importers will prefer a higher value. Thank you for watching. Don't forget to please like and subscribe. If you have a topic you would like to suggest, leave a comment.